So, what are the common building blocks for any investment portfolio? Technically, you can invest in almost anything that gives you potential return for your money. But the majority of retail investors put their money towards a few types of asset classes. But before we even go there, what is an asset class? Fundamentally, asset classes are investments grouped by their similar characteristics. These include equities, fixed income, real estate, commodities, and cash. The finance industry is full of complex jargons, which can make simple concepts appear much more complicated than they actually are. A good example of this are equities. Equities are also commonly known as stocks or shares, which are traded on stock exchanges and can be accessed most commonly through a brokerage. In essence, holding an equity represents ownership by an investor in a company, proportionate to the percentage of shares in the company that they own. While there are many different types of shares, most retail investors, like yourself, will be trading what's commonly known as ordinary shares. And for many, this will make up the majority of their overall investment portfolios. Equity ownership allows people to put their money towards companies or brands they believe in, and through this also benefit from the company's growth going forward. Investors buy equity with the expectation that the value will increase, or sell when they expect that the value will fall. Another way equities generates returns for investors is when companies distribute a portion of their profits to shareholders in the form of dividends. Dividends are a way for a company to reward shareholders for investing in that company. Usually, they're paid out regularly, sometimes every quarter. But the amount and frequency will depend on the profits and decisions made by the company. In general, the better a company's profitability, the higher the dividends a shareholder may receive. However, always remember that the value of equities will fluctuate both up and down. So a portfolio containing only equities may potentially see big swings in value. So, what can investors add to their portfolio to hedge against this? Fixed income. Fixed income refers to investment products which provide a fixed return to investors. And one of the most popular products in this asset class are bonds. The concept of bonds is actually quite simple. A bond is a request for a loan. When an organization, such as a company or a government, want to raise money, they can issue a bond. Purchasing this bond essentially means you're lending them your money for a predefined period of time, also known as the tenure of a bond. In return, you'll be paid a fixed amount of interest in the form of a coupon on a regular and predictable timeline, usually a set number of years until that bond matures. On the date of maturity, the bondholder, i.e. you, is returned the initial loaned amount, otherwise known as the principal or face value. In addition, the market value of a bond will fluctuate based on market demand, as these bonds can also be actively traded on the secondary market. What this means is that even though the principal remains unchanged, bonds may trade at different market price due to demand and supply. This can result in a difference between the coupon rate and the return that you earn if you hold the bond all the way to maturity, also known as the yield to maturity, or abbreviated as YTM. The YTM factors the additional capital appreciation that you will receive if you hold this bond to maturity, in addition to the coupon amount earned through the tenure of the bond. Having bonds in your portfolio helps you hedge your investments against the volatility of stock markets, as you know exactly how much you will receive at maturity, while also being rewarded with interest on a regular basis. However, it's not without risk, and while regarded generally as a safer asset, you will still lose money if the company goes bankrupt. However, the benefit of holding bonds is that you, as a creditor, will be prioritized over shareholders during the insolvency proceedings and can potentially recoup some of these losses. Next, and perhaps the most well-known asset class, is real estate. There are two main ways people invest in real estate. The most common method would be to purchase physical real estate, such as houses, apartments, commercial buildings, or land. Investors make returns by selling these properties whenever the value rises, or by renting them out and earning a yield. Another increasingly popular way to invest in real estate is through a real estate investment trust, often simply referred to as just a REIT. REITs are basically companies that own, operate, trade, or generate rent through real estate assets. You invest in REITs by buying shares of those holding companies through major stock exchanges or through funds composed of REITs. Some household names you may have heard of include Mapletree, which owns properties such as Vivo City, and CapitaLand, which owns Raffles City Mall and even office buildings such as 6 Battery Road. These REITs generate revenue by leasing the properties to tenants and are legally bound to pay 90% of all profits as dividends, which creates a steady stream of income for their shareholders. Both methods have their pros and cons. Investors who directly buy real estate have control over the property and how it is bought, managed, or sold. Real estate is also a physical asset that can provide a sense of security for many investors. However, buying direct property typically requires a substantial amount of capital upfront and comes with many additional costs, such as fees, taxes, and maintenance. Direct property investment can also require active management and hence a significant time commitment. For example, dealing with multiple tenants and various maintenance issues. Also, real estate is not a liquid asset, meaning it can take time to sell and convert into cash. While REITs, on the other hand, are highly liquid because their shares can be bought and sold on major stock exchanges. This also means you can invest in and gain exposure to the property market without the large amounts of capital typically required to purchase a physical real estate. Another benefit is diversification, as REITs often own multiple properties in various sectors, such as residential, commercial, or healthcare. This reduces the risk of relying on the prospects of a single property or segment. REITs also take full responsibility for the management of properties. Hence, there are no additional costs or time burden for investors. However, REITs are subject to market fluctuations and can be as volatile as stocks, especially in economic downturns. Next, let's talk about commodities. Commodities are basically the raw materials used to make the products we use in our day-to-day lives. If you're thinking that sounds very broad, you're right. There are a huge number of commodities which can be traded. Some of the most commonly traded commodities include metals such as gold and silver, energy such as oil and natural gas, agricultural products including coffee and wheat, and even livestock like cattle and poultry. Investors tend to have commodities in their portfolios for 3 key reasons. One is the reduction of risk through diversification, as commodity prices often move very differently compared to stocks and bonds. Another is the protection against inflation. As prices of products go up, the value of commodities that are in these products and that they're made from generally rises in tandem. The third reason is the potential for returns when there is a mismatch between supply and demand. For example, when there are disruptions to the supply of oil, the price and value of oil typically rises and can generate significant returns for investors. Finally, cash is the most stable, accessible, and non-volatile type of asset that you can hold. And this is most commonly held as savings or fixed deposits in banks. However, increasingly, there are a number of alternative cash-like investments that are growing in popularity, such as money market funds, which are portfolios comprised of short-term deposits and bonds. So, now we've gone through all these assets, how can you invest in them? Well, there are 2 main ways. If you know exactly what you're looking for, you can directly purchase many of these assets through a brokerage or hold them collectively through a fund. However, if you need a bit more guidance, you can choose for a managed solution with the help of a human or digital financial advisor.